So you're purchasing your first property and you need to take out a loan. Well, most of my clients assume that they have to take out a 30-year fixed loan. But what if I were to tell you that there's actually another type of loans called ARMs, adjustable rate mortgages, that sometimes, particularly at the shooting of this video, could make a lot more sense for you and ultimately save you tens of thousands of dollars. In today's video, I'm gonna give you guys a complete breakdown of fixed term loans versus adjustable rate mortgages, explain the difference of each, pluses and minuses, when you might use them, and so on. If you guys don't know me, my name is Jankowitz. I'm a realtor in Cambridge and Somerville, Massachusetts. I've closed over 300 transactions in the last 3 years. If you guys like these videos, please take a second to hit that subscribe button in the link below. If you guys have questions, there's a free 15-minute Calendly link also in the description below, so feel free to click that. I'm happy to hop on a free call. All right, let's get into it. So let's start off with what most people do. Most people, when they're buying a home, they talk to their parents, they talk to their friends, they talk to a sibling who's gone through the process, and they ask them what they do. And most of the time, what's recommended from that friend, from that parent, is that 30-year fixed term loan. It's what they always hear, and that's what they always end up going with. But it turns out there's different types of loan products. And for the sake of this video, we're gonna focus on two specifically, the fixed term loan and the ARM loan. Now let's, to start, talk a little bit more about what the fixed term loan actually is. So a fixed term loan is exactly what it sounds like. It's a loan for a fixed period of time, and for that entire period of time, you have the same interest rate, and at the end of the term of that loan, your loan will be paid off in full. So for example, if you have a 30-year fixed term loan, you have a set interest rate, it's locked in for all 30 years, you pay the exact same amount each month, every single month, and at the end of the 30-year period, your loan is paid off in full, and you now own that property outright. Now, I should mention with fixed term loans, you don't always have to go with a 30-year fixed term, although that is definitely by far the most common. And generally speaking, every client that I know of, for the most part, will go 30-year fixed. I will add one caveat. I actually have a client right now who is planning on doing a 15-year fixed term, but that's relatively rare. Understand that if you purchase a home and it has a lower term, say a 15-year fixed year term, you're gonna be paying a lot more each month. So for most people, from a financial perspective, it doesn't make sense. Of course, the one big plus that a lot of people don't talk about, if you do agree to say a 15 or 20-year fixed term loan, is you're paying a lot less interest over the term of the loan. But again, the numbers wise, it oftentimes does not make sense for the vast majority of buyers if they decide to go the fixed term rate. But wait, there is that other type of loan I mentioned earlier. It goes by ARM, A-R-M, which stands for adjustable rate mortgage. And whereas a fixed is fixed over the entire term, adjustable rate means that it's fixed for a period of time, and then over time, the rate will adjust. And the most common flavors that I tend to see are the 5, 7, and 10 ARMs. For example, if we were going with a 10-year ARM, it would mean that for 10 years, you would get a locked-in rate, after which the rate would fluctuate. So with the adjustable rate, after that 10-year period, again, the rates can go up or down depending on where that index is. It could go up, it could go down. Generally speaking, there is a cap of how much it could go up over a certain period of time. So in other words, there could be, say, a 2% cap. So if you had a 10-year ARM and it was at 3% and there was a 2 percentage point cap, that would mean at any given year, it could go up or down 2 percentage points. The next question I typically get was, if I were to go with an ARM, which ARM would I go with? Should I go with a 5-year, a 7-year, a 10-year, or even seen a 3-year? Well, this is a very personal question, and it depends on your risk tolerance. For me personally, what I recommend for most of my clients, for most scenarios, although not all, is to stick with a 10-1 ARM. And the reason I go with a 10-year adjustable rate mortgage is because 10 years, generally speaking, is a pretty long period of time. And that's gonna give you a lot of time to do a lot of different things. First of all, over 10 years, that's a lot of time for your property to grow in value. And if you're buying in an area that has a lot of growth potential, it's a lot of chance for the property to appreciate in value. In addition to that, it gives you a chance to pay down that mortgage. Over 10 years, you're gonna gain quite a bit of equity. In addition to that, if ultimately you wanna rent out the place, rents generally go up in a lot of the areas I work. So over a 10-year period, you're looking at a higher rent amount over time if you were to decide to leave and rent the property out, which gives you additional flexibility. Over a shorter period of time, like say a 5-year or even a 3-year, it's not really a long period of time. A lot of things can happen in the market in a short period of time. You could be in a really tough spot where 5 years later, you can't stomach your monthly payments anymore. And that's the worst situation to be in. So you want to make sure essentially that you give yourself enough runway to build up equity, to hopefully build up some appreciation, to give yourself a little flexibility with what you want to do with your property. Hopefully that makes sense. So now I want to take a second to go over particular scenarios where it might make sense to go with an ARM over a fixed term rate. Because at the end of the day, why would you go with a rate that's going to change after a period of time where you can get it locked in for the whole period? So there's a couple scenarios where this might make sense. Scenario one would be if you're in a situation where you know you want to buy, say you want to buy in Somerville, maybe you're on a contract job, you're only going to be there for 5 years, then you're going to be out of there and you know you're going to want to sell in 5 years or 7 years or 10 years. Well, in that scenario, if you're very, very confident that you're going to leave in that period, it's at least worth comparing the ARM rate versus the fixed term rate. And if there's enough of a spread there, in other words, a big enough gap between the interest rate for the ARM versus the fixed, then you should seriously consider the ARM because you could be saving thousands, if not tens or 20, 30,000 plus over the life of the loan. The second scenario is if there's just a large spread in general and it's a relatively longer ARM, it's probably worth considering. So for example, for me, I purchased a condo in Medford. I decided to go with a 10-1 ARM. We got a great rate of 3.75. Now that was a 10-1 ARM, whereas if I were to buy a 30-year fix at the time, we're looking at more like 5% or maybe even slightly higher. So we're looking at 1.25, maybe 1.5 compared to the 30-year fix. That's a big spread. I felt confident enough over the 10-year period that I'd be in such a good position in 10 years that I could either potentially sell for a much higher price, rent out the property. Also, that gives me 10 years to potentially refinance the property into a fixed term rate. It's a very long time range. So I have a lot of flexibility, a lot of different things I can do, and I'm saving a lot every single month, every single year in terms of what my payments look like. So if there's a large enough spread, I encourage clients to at least consider the ARM. Again, it's a personal decision depending on your risk tolerance, but it's at least worth considering. So just to quickly go over scenarios where you might want to consider an ARM. Either A, you're going to leave after a period of time, you're very confident, but you want to own during that period. That would be one example. The other is when there's a big enough spread between the ARM and the fixed term rate. Again, the big thing to think about is you want to make sure you have enough runway. I generally recommend going to 10. Some people have the risk tolerance to go a 7. I personally like the 10. And then within the 10 ARM, think about all of the things that you have going for you. You can be building equity over 10 years. You can be building appreciation over those 10 years. If you feel confident about your financial position over a 10-year period, if you think it's going to keep getting stronger, you're going to be in a position where you're going to have more financial general flexibility. You'll also have the chance to refinance. So you have to factor all those things into play in terms of the risk benefit of going with an ARM and potentially saving on your monthly payments. Anyways, I hope you guys feel a little bit more well-equipped when considering which loan program to go with. I think there's a lot of factors to consider. A good loan officer also will help walk you through these dynamics in more detail. There's also other type of programs. There's programs for doctors, for first responders that can help you reduce what your down payment is, remove or reduce PMI. So always good to talk to a qualified loan officer. I'm happy to set you up with one if you need one. If you guys have any questions about any of this, hit me up on my Calendly link, description and a link below. Please subscribe. If you guys have general questions, hit me up by text or email, and I'll see you guys next time.